Last year, consumers spent over $350 billion using Buy Now, Pay Later. That's more than the GDP of Denmark, split into four easy payments. You've seen it everywhere. Klarna at checkout, Affirm on Amazon, Afterpay at the register. But here's what almost nobody explains. When you click Pay in 4, you're not just deferring a payment. You're triggering a chain of financial infrastructure. Underwriting, merchant settlement, funding, and risk management, that happens in milliseconds. And the companies running that infrastructure have built something genuinely different from anything traditional lending has ever looked like. This is how Buy Now, Pay Later actually works. Not the consumer version, but the machinery underneath it. To understand BNPL, you have to start with the problem it solves. And it's not the problem most people think. The standard explanation is that BNPL helps consumers afford things by splitting payments. That's true on the surface. But the real problem BNPL solves is a merchant problem. Online retailers lose roughly 70% of shoppers at checkout. 7 out of 10 people put something in a cart and then leave. Price friction is the number one reason. The customer wants the product. They can see the total. And they hesitate. BNPL eliminates that hesitation. When a merchant adds Klarna or Affirm to their checkout page, conversion rates typically increase by 20 to 30%. Average order values go up by 30 to 50%. That's not a consumer finance story. That's a merchant revenue story. And it's why merchants are willing to pay for BNPL, which brings us to how the money actually flows. Here's the transaction chain, step by step. You're shopping online. You pick a $200 pair of headphones. At checkout, you see the option to pay in 4 installments of $50. You select it. In the next 2 to 3 seconds, several things happen simultaneously. First, the BNPL provider, let's say Affirm, runs an instant credit decision. This isn't a traditional credit check. Affirm uses a proprietary underwriting model that pulls a combination of data: your identity, your history with Affirm, sometimes a soft credit pull that doesn't affect your score, and behavioral signals from the transaction itself. The decision comes back in milliseconds: approved or declined. If you're approved, Affirm pays the merchant the full $200 immediately, minus a merchant discount fee, which typically runs between 3 and 8% depending on the merchant's size and the BNPL provider's terms. So the merchant receives somewhere between $184 and $194 on day one. The merchant is done. They got paid, they shipped the product. Now Affirm owns the receivable. You owe Affirm 4 payments of $50 over the next 6 weeks. Affirm collects those payments from your linked debit card or bank account on a fixed schedule. If the plan is interest-free, which most pay-in-4 plans are, Affirm makes its money entirely from that merchant discount fee. If the plan is a longer-term installment with interest, which Affirm also offers for larger purchases, they earn interest income on top of the merchant fee. That's the basic flow. Merchant gets paid up front. BNPL provider takes on the credit risk. Consumer pays over time. Now let's go one layer deeper, because the funding model is where this gets really interesting. When Affirm pays that merchant $200, where does the money come from? BNPL providers don't fund loans from a vault of cash. They use a combination of funding sources that look a lot more like a structured finance operation than a simple lending business. The first source is warehouse credit facilities, revolving lines of credit from large banks that BNPL providers draw on to fund new loans. Think of it as a credit line specifically designed to fund short-term consumer receivables. The second source is asset-backed securitization. This is where BNPL starts to resemble the broader capital markets. Affirm, Klarna, and others bundle thousands of BNPL receivables into pools and sell securities backed by those pools to institutional investors. The investors get a yield. The BNPL provider gets fresh capital to fund more loans. It's the same structural concept as mortgage-backed securities, but applied to $50 installment payments on headphones. The third source, for some providers, is direct deposits. Affirm holds a savings product. Klarna is a licensed bank in Europe. These deposit bases give them a lower cost of funding than pure capital markets financing. The funding strategy matters because it determines the economics. A BNPL provider paying 8% on warehouse debt and losing 2% to defaults needs that merchant fee to cover the spread. A provider funded by low-cost deposits has a structural margin advantage. This is why Klarna's European banking license isn't just a regulatory detail, it's a competitive moat. So how does the underwriting actually work in real time? Traditional lending takes days or weeks because it relies on comprehensive credit bureau data, income verification, and manual review. BNPL underwriting happens in under a second because it's built on a fundamentally different philosophy. The core insight is that a $200 purchase split into 4 payments is not the same risk as a $10,000 personal loan. The exposure is tiny. The repayment window is 6 weeks. And the transaction itself contains signal. What's being purchased, from which merchant, at what time, on what device. BNPL providers build machine learning models trained on millions of prior transactions. These models weigh hundreds of variables simultaneously. A first-time user buying from a reputable merchant at a reasonable order value gets approved at a high rate. A repeat user with missed payments trying to make a large purchase from a high fraud risk merchant category gets declined. The model adjusts in real time based on portfolio performance. This is why default rates on short-term pay-in-4 products are relatively low, typically 1 to 3%. The underwriting is fast not because it's careless, but because the risk profile of a 6-week microloan is fundamentally different from traditional consumer credit. Where does BNPL fit in the broader fintech infrastructure landscape? This is the piece most coverage misses entirely. BNPL is not a standalone product category. It's an embedded finance product, one of the most successful examples of financial services being distributed at the point of need rather than through a traditional financial institution. When Shopify offers Shop Pay installments, that's embedded BNPL powered by Affirm's infrastructure. When Amazon integrates Affirm at checkout, that's a non-financial platform distributing a lending product. The pattern is identical to embedded banking, embedded insurance, and embedded payments. The platform owns the customer relationship. The infrastructure provider supplies the regulated capability, and that infrastructure layer is where the durable value sits. Consumer-facing BNPL brands will compete on marketing and user experience. But the companies providing the underwriting engines, the merchant integration APIs, and the funding infrastructure, they win regardless of which consumer brand is on top. Here's the picture. Buy now, pay later looks simple from the outside. 4 payments, no interest, easy. Underneath, it's a sophisticated operation combining real-time underwriting, structured funding, merchant economics, and embedded distribution. The companies that built this infrastructure didn't just create a payment option. They built a new distribution channel for credit, one that meets consumers at the exact moment of purchase intent with a risk model designed for that specific context. The next time you see pay-in-4 at checkout, you'll know there's an entire financial system executing in the background, in the time it takes you to click a button. If you want to understand the broader embedded finance infrastructure that makes products like BNPL possible, watch this video next. Subscribe for 2 videos a week on the infrastructure and business models behind modern finance. No hype, just how it actually works.